Is Santa Claus going to come and save the stock market? This is some wild and crazy price action. So today's video is going to be focused on that. You're watching the Stock Market Brief. Make sure to hit that thumbs up. That's exactly what that was. It looked like an elf thumb. Go figure. Now, we've been talking about these BP charts, how they've been overextended. They have had negative divergences. I'm not going to keep on continuing to talk about that, but they're resolving themselves, and they're resolving themselves right now to the downside. Now, we talked about this chart also on prior videos. We talked about this expected move, and right now we're getting a 2 sigma move outside of the weekly expected move. There's a 95% probability that it will close within the 2 sigma range, which is really roughly something like that. Okay, this big range up in here. However, we do have some price action breaking down, and I know it has a lot of people worried. A big asset to watch is going to be the dollar. The dollar is kind of poking its head out right here as if it's going to get some momentum kind of to start to the upside, which could very well break the S&P 500 for some further downside. Today's move looked like a complete risk-off type move where bonds were up, dollar was up, and many assets were obviously down. Now, if we take a look at UUP, you can see here we're towards the upper weekly expected move. We haven't tagged it yet, so it allows for potential some more upside up here, and then it could potentially take a break. Now, I could say this too as well. You have price action that expanded. Now it is in contraction mode, also wedging with a positive divergence there on the MACD and a positive divergence on the histogram, and you have this bullish crossover taking place potentially that can send the dollar up for a little bit of a rally. We don't know how high that can go, but that can put a lot of pressure on the S&P 500, making it very hard for Santa Claus to come in and save the market. However, we got some decent news here soon, so we'll talk about that momentarily. This is the S&P 500 on the 15-minute time frame. We're using the SPY, and you can see it was just wicked sell side all day back into this chop box you can see here. And if you look at this volume shelf profile, look at where it came to. Actually, let me just draw it like this, like a distribution curve. You can see how it came outside of it, and boom, it came right back into the point of control. And then we started to see a bounce from this level, right? This was prior resistance, and then resistance can become support. You can see, and now it's coming into an area of support as well. We have a bullish crossover on the price momentum oscillator too as well, which could indicate that we could very well see stocks get some relief. We'll continue on because, okay, what can potentially cause more, damage to the downside to potentially even fill this downside gap? Well, we do have some data coming out tomorrow. It's relatively an easy kind of data type week. We have Jerome Powell next week, which will be big in CPI, but we have the PPI, month over month, and Michigan Consumer Sentiment preliminary for December. So that could potentially waver the markets, right? They're very dependent on this type of data. So we shall see, how it responds. Now, what is the market pricing in as far as those data drops and the risk going into tomorrow? The S&P 500, we'll look at the SPY, is pricing in approximately a plus or minus 3.7 dollar expected move. So that means it could take us back up into this range right around 398.98, which is right back to where the lower weekly expected move, which 68% of the time it closes within that range. So is it possible that we get some rally back into there? Yes, of course. I mean, just look at to the left of the screen. Price action has just been in a chop box, and when it's been here, it goes like so. And we got outside of it, we came back. So it's just a channel. It's just a range as it stands right now. Now, you got to be aware we do, if you look at this volume shelf right here, if we start breaking down, there's not much volume traded into this area if it breaks down, so it can, like I said, come to close that gap. However, tomorrow it's just looking at probably potentially around 390 to the upside, just below 398. Now, remember, markets are volatile. And we can see, like we've seen just this week, a 2 sigma move. So you can always, look out further too, just in case where you'd have that 95% probability, or I forget the exact number, 95, 98% probability of it closing within that range, which is quite large. Now I want to show you something here. This is a book map. I use them intraday. I don't really show them on my market briefs, but I want to start bringing this in because of the important levels here. So this was earlier in the day. This is 7:30 in the morning. If you don't know what Bookmap is, it paints, like, think of it as like level 2s, right? So level 2s, you probably are aware of this if you're day trading. These things move really fast. It's hard to track. Well, Bookmap paints it onto the screen so you can see levels of liquidity, right? This is all about an auction. It's like taking the blindfold off. It's, you know, looking past the candlesticks. And what I like so much about this is you can see levels of high liquidity where price can potentially pull into and absorb that liquidity. And if, you know, for example, this morning I looked at a couple of levels. So I looked at 387. You can see this little kind of spike right here of orders, and then you could see right down here 39.50, and you could see on the heat map it had some, you know, a little bit more red right there, and then it's kind of blocking it, but it had some red here too as well because I drew a horizontal line. And this is right at around 7:30, and let me show you what took place. So if we look at 7:30, which is right about here, price pulled into that 39.50 level. Okay, it pulled into 39.50. And it had a bunch of offers right up in here. So it started bouncing from that level, which made for a good intraday trade. It pulled back in, and then it's bounced back from that level. And then finally through here, it absorbed all that liquidity and it started pushing down. And you can see the other levels, you can see right here on the heat map, which we talked about, like the liquidity started moving down further and further. Now, the reason why I'm showing you this more importantly now is to understand levels potentially going into tomorrow. Now, keep in mind, these orders can get removed in the blink of an eye, but as it stands right now, it might be a very important level to watch because at 10:30 this morning Pacific Standard Time, you can see that a big order has been sitting since that level, and these can potentially act like magnets. So that's at 3,900. So going into tomorrow, if we get some more further downside, start looking at 3,900. And what I found so interesting about this, as price was just, you know, underneath the daily VWAP all day today, we have an expected move of still $35 on ES, and we have the expected move of $3.7, right? And what does that take us to the low end? It takes us to 390 on the SPY, and guess what? It would take us just about to 3,900 on ES. So if we get the expected move down to these levels, also pay attention to this liquidity down here, because it could potentially, if it comes in here and gets absorbed and then no more sellers step in and all of a sudden there's more buyers, you can get a bounce from that level similar to what we saw here. Now that's not a guarantee, but it's something to potentially watch for going into tomorrow's trading session. So hope that helped out. If you want to learn more about Bookmap, I have a link in the description. Let's take a look at the cues. You can see here also trading within a chop box, and it's just got completely destroyed too, like everything, right? Okay, so straight down basically. And what do we have now? Well, first and foremost, we're outside of the weekly expected move. You can see that. That's that line right here. That's the lower weekly expected move, but we are pulling back into this area of prior support. If we start breaking down from these levels, we still have this monster gap that we can potentially come and fill. So that's going to be the one to watch there. But overall, like we had the Jerome Powell come out, boom, everyone got so excited. And what did we say? Things are hot, things are extended. Careful, this is not where you FOMO, right? So if you started buying here, you got wrecked, okay? And now what I'm trying to say is while price got completely smashed, if you're selling here, right? Boom, it might go right back up and all you're doing is trading in a range. Now, what if it continues to crash? Okay, cool. If you got into short positions or you started mitigating some of your longs up here, you can start looking for new longs at other key levels. That's how you trade this. Now, me personally, today I was covering shorts into this lower level. That's just what I was doing. Now, I wasn't trading specifically the Qs. I had other various assets and they started making some decent profits. So I wanted to capture that on big red days. I mean, it was down 2%. Okay, the Qs were down 2%. The S&P 500 was down 1.5%. So these are some big moves in these index products. Now, if you look at IWM, also completely crushed to the downside. It did actually break this level over here. So you can see that this is an area, it's been also just in a trading range where we had a very strong move up, strong moves down, you know, strong move back up to the middle of the channel, boom, 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 right back down, okay? So yeah, we have this big gap beneath us that could potentially come and get filled, but you got to understand, overall, we are still within a trading range. So what happens if we just come right back up into this area? Can you be shocked? Absolutely not. And there are reasons to believe that we can get a bounce. There's also reasons to believe that we can flat out have a crash, okay? Because the conditions are clearly pointing to some risk off type stuff, okay? And crashes can happen like this, right? They go overextended, you have some selling, people think it's gonna bounce, and all of a sudden it gaps down and goes further, and you're like, oh, no, it's fine. And then you know, it happens so quickly. Overall, if you look at the 11 sectors, how did they perform? You have utilities, okay? This is what I mean by risk off. You have utilities, consumer staples, healthcare, real estate, very defensive names. Where were they? They were all in the top 4 of the 11 sectors that make up the S&P 500. Energy got cracked, tech got cracked, communication services, they've been getting cracked all year long, okay? Now, if we continue on, take a look at bonds. Bonds actually picked up a little bit, and you can see that we're just within the middle really of this weekly expected move. I mean, it's Tuesday, people. It's only Tuesday, and we've seen this type of movement. If it goes up more to the upside, start looking at around 110, to the downside, right at around 104. We'll continue on there because what I find interesting is the yield curve continues to get deeper. We have the 10-year minus 2-year yield curve at minus 83, and the 10-year minus 3-month, people, is now at minus 86 basis points. Absolutely bonkers. And it's probably going to go deeper by the looks of it. Now, as we see here, the summation index still hasn't crossed over to bearish trend, but we're starting to see it curl. One big thing that took place today was the Nasdaq McClellan oscillator did cross down below that 0 line, indicating that we could potentially see that negative divergence resolve more to the downside. Doesn't have to happen in one day or in a straight line, but that's what we're watching. The summation index for the New York Stock Exchange started to curl over here, but it's still above 0, and the parabolic star is still below us. Take a look at this negative divergence that we've been following and tracking since mid-November. It crossed down through that 0 line, which could indicate that we're getting some breath to the downside. Like I said, it doesn't need to happen in a straight line. It can, but it doesn't have to. So we need to be prepared that the market can be potentially coming into more downside. Going into tomorrow, ES, we're looking at 3,900. SPY, we're looking at 390. Okay, this could very well be part 3 of the bear market, where we had 1 bear market rally, 2 bear market rally, 3 bear market rallies. And this bear markets typically happen in 3 stages. So if this is, you know, a potential rising wedge or even a bear pennant, look at that. I mean, that can bring us to new lows, and that could be some scary stuff going into 2023. But let me remind you before we close off, is good opportunities, great opportunities are going to be coming in when we're out of this, okay? So stay solvent, protect your capital, focus on risk. The last thing I want to touch on is obviously the zones, which is something that I use for managing risk. It gives me a great overlay of the market. It's something that I share with my swing trading community. It's something new that I added in there, you know, early, a few months ago or something like that. And it allows me to quickly identify a bunch of different assets from an intermarket perspective over here. So important assets, and it allows me to quickly identify what potential upside they have, what potential downside they have based on this the zone. So think of it as kind of as like a Bollinger Band. It's not a Bollinger Band. It's actually using mathematics from the book called Misbehavior of Markets by Benoit Mandelbrot. It was originally, this application was originally designed by Joe Catanzara. I know I'm mispronouncing his name, but it's an excellent tool. All I'm doing is extracting the data and I'm overlaying it on just overall a lot of asset classes. I'm doing this, but I'm doing fixed income, I'm doing global equities, commodities, and I compile it in an Excel doc. Besides the point, if we go over here to the range, this allows us to see where price is, the closing price is within these zones. Now, these aren't like, okay, oh, it's all green, so that means buy, right? It's at the lower range. That doesn't necessarily mean what it is, but it allows you to see, oh, okay, well, things are getting back overextended the downside. Now, if you remember just 3 or 4 days ago, this whole screen was lit up red, okay? So that's how you determine, like everything was red, and we were saying, okay, be careful here, right? Things are getting hot. Now, well, guess what? Things are getting green. So does this mean buy the Qs? I mean, the Qs have not been doing good all year, right? It doesn't necessarily mean that, but what it does mean is if we get a bounce, you can potentially add to assets that have been working this year. For example, like we said yesterday, consumer staples, utilities, and so forth, right? Those are defensive names, defensive sectors. But I must remind you, if the VIX starts getting back into the mid-20s to even 30s, all those assets, including the defensive names, can get hit, okay? One last thing, I'm gonna keep on going. One last thing I wanna show you is smart money versus dumb money. This is the smart money, this is the dumb money. The smart money is bonds, okay? Bonds are just considered traded by smart people, buys traded by dumbos like me. But what I like to look at here is you can see sometimes when we have on this hourly time frame where HYG, the smart money, says, hey, we're going to put where we have a lower high, whereas the SPYs like keeps on pressing higher and higher. And it's like, yeah, FOMO, woohoo. Well, smart money is telling us, hey, this rally might end. And you can see these red boxes here, boom, it went to the downside. This red box right here, boom, to the downside. But on the flip side of that, you can see when smart money puts in a higher low, and dumb money puts in a lower low. So, oh no, all the dumb people, like they capitulate to the downside, but all the smart money is like, no, it's time to rally. And then guess what? Boom, we move to the upside. Boom, we move to the upside. The reason why I'm showing you this right now is because, hey, take a look over here. HYG, you can see a subtle divergence playing out, or potentially it's building. It could potentially play out. There we go. You can see HYG put in a higher low today, where SPY put in a lower low today. So smart money is saying, hey, things are potentially getting overextended, right? And it could potentially bounce. And SPY, it just went basically straight down. We're having a 2 sigma move, but 95% of the time it finished within that. 68% of the time, right? It's that one standard deviation. So potentially we can get a bounce. And where would that put us on the SPY? I mean, it's just right back in this range. Okay, so keep continuing to watch that. Remember this level, 390 on the SPY. If we get some further downside, that'd be the level that I want to keep a close eye on. Be careful and be safe, people. This, just by seeing these overextensions, it doesn't mean just start pressing super long and averaging in while price is going against you. Remember, things can happen. It's a very, very difficult time to navigate these markets. So just focus on risk first. That's all. See you later, everybody.